Imagine it's the year 1300. You're on the Ponte Vecchio in Florence, watching a merchant caravan from England arrive, laden with raw wool. The transaction unfolding before you is worth more than most people will earn in their entire lives. That wool traveled 1,200 miles without any modern technology. No trucks, no telegraphs, no credit cards. Yet the financial instruments facilitating this trade, letters of credit, insurance contracts, and the double-entry accounting meticulously tracking every florin, are so sophisticated that they are still in use today. This is an exploration of the system that pioneered modern capitalism. By the end of this presentation, you'll grasp why your Amazon delivery, your cryptocurrency wallet, and your corporate supply chain all trace their origins to innovations developed by Florentine wool merchants who lived and died 700 years ago. You'll also see why every single pattern they unearthed, including catastrophic failures, is repeating itself right now. This narrative will get dark before it becomes remarkably useful. In the year 1200, Florence had a population of 50,000. 1 century later, by 1300, its urban population had swelled to 120,000, with an additional 300,000 in the surrounding countryside. Italy became the most urbanized society on Earth, with 20% of its population living in cities. These inhabitants weren't farmers, they were wool workers. The Arte della Lana, the Wool Guild, directly employed 30,000 workers and indirectly sustained 1/3 of Florence's entire populace. They produced 100,000 lengths of cloth annually. However, what made this a supply chain revolution was that Florence itself had no sheep. The wool originated in England, the dyes came from the Levant, and the finished cloth was destined for markets in Flanders, southern France, and across the Mediterranean. This illustrates globalized production in 1300, organized through affluent merchant firms that contracted with independent workers dispersed across the city and rural areas. Spinners, weavers, fullers, and dyers all operated in separate locations, with their work coordinated through inspection and certification. Does that sound familiar? That's essentially your modern gig economy, or companies like Nike, designing in Oregon, sourcing materials from 12 countries, and assembling in Vietnam. The pattern is the same, just a different century. And here's what powered this entire system: taxes on imported wool, excise duties on finished cloth, guild fees, and export tariffs. Collectively, these represented one of Florence's largest revenue streams. The prosperity of the wool merchants dictated whether the city could pay its soldiers, fund civic improvements, and ultimately survive. The arithmetic was brutal. When trade thrived, everyone prospered. When it faltered, the entire city would collapse. Now, let me introduce you to the innovation that made all of this possible: double-entry bookkeeping. Before this system, if you ran a business with operations in multiple cities, handled deposits from the Pope, extended loans to royalty, and conducted currency exchanges across Europe, you lacked a systematic method to track the true location of your money. You could go bankrupt without even understanding why. Double-entry bookkeeping resolved this with a single equation: assets equals liabilities plus equity. Every transaction was recorded twice, exhibiting a credit and a debit. Different columns, always in perfect balance. The Medici Bank pioneered its systematic application. When Luca Pacioli finally documented the method in 1494, he dedicated 150 pages to explaining what Florentine bankers had been doing for decades: trial balances, balance sheets, and profit and loss statements. Here's why this is significant. Centuries later, when manufacturers like Josiah Wedgwood adopted this system, they could suddenly differentiate between fixed and variable costs. They uncovered the economics of mass production and transformed manufacturing. Modern supply chain management, tracking inventory across continents, calculating profit margins in real time, and analyzing which products are truly profitable, is literally impossible without the accounting framework these Florentine merchants invented. Your chief financial officer, your enterprise resource planning system, your blockchain transparency, all descend from Florentine wool traders trying to ascertain if the cloth they shipped to Bruges 3 months prior had actually been paid for. But accounting is only effective if you can trust the currency, which brings us to 1252 and the invention that revolutionized everything: the Florentine florin. Weighing 3.5 grams of pure gold, its consistent quality was maintained without debasement for 280 years. from 1252 to 1533. Nearly 3 centuries, without deceit, without reducing the gold content, without inflationary games. The Florentines had a saying stamped on every coin: San Giovanni non vuole inganni. St. John does not want deceptions. The image of St. John the Baptist served as a guarantee of authenticity. By 1300, the florin had become the international reserve currency. Merchants from the Levant to the Baltic readily accepted it. Approximately 150 European states created copies, from the Hungarian forint to various ducats, all imitating the florin's weight and purity. This gave Florence seigniorage rents, the ability to profit from minting currency. Foreign merchants brought raw gold to Florence to be minted into florins, paying fees. Florence captured the spread between the market value of the gold and the face value of the coin, essentially legitimizing currency printing. But here's the stroke of genius that truly enabled long-distance trade: the letter of credit. Picture this. You're a Florentine cloth merchant traveling to London, carrying 1,000 gold florins through bandit-infested territories for weeks. One robbery, and you're ruined. The solution? Deposit 1,000 florins at the Florence branch of the Medici Bank. You receive a piece of parchment, a letter of credit, authorizing the London branch to pay you the equivalent in pounds sterling after a specified period. You travel with paper. The gold never moves. Upon arrival in London, you present the letter. The London Medici office pays you, and the transaction clears through the bank's internal accounting. Everyone is safe. No one gets robbed. And here's the brilliant part. The bank builds a commission into the exchange rate spread. The rate quoted in Florence differs slightly from the rate in London. That difference, often 20% to 50% annualized, represented pure profit. This marked the birth of international banking, the ancestor of wire transfers, SWIFT codes, and correspondent banking relationships. Same pattern, same outcome. Now, this is where it gets genuinely interesting. Earlier Florentine banks, such as the Bardi and the Peruzzi, were structured as centralized partnerships, one single legal entity, with all branches and operations unified under single ownership based in Florence. This proved to be a death sentence. When one branch failed, the losses spread to all others through shared liabilities. When external shareholders accumulated controlling shares, they could seize the entire company from the founding family. And when the senior partner died, succession disputes destabilized everything. The Medici invented something different: the partnership system. Instead of a single unified bank, they established a holding company in Florence that held a controlling interest, typically 2/3 of the capital, in legally independent partnerships operating in various cities and industries. Rome, Venice, Milan, London, Bruges. Each was a separate legal entity with its own capital, accounting, and commission structure. The branch managers were not salaried employees. They were shareholders who invested their own money and received a share of the profits. For example, the Bruges governor in 1455 invested 1,000 florins out of a total capital of 6,000, yet received 1/5 of the profits, not 1/7. This aligned incentives. Managers couldn't engage in private deals, accept bribes, or lend to monarchs without approval. Here's why this matters. This legal separation meant a crisis in one branch couldn't trigger a cascading collapse. When one branch failed, the others survived. This is the blueprint for the modern multinational corporation structure: decentralized subsidiaries, local management autonomy, holding company coordination, profit-sharing incentives, and centralized policy, still in use today. But even the best systems eventually break. The year is 1343. The two largest banks in medieval Europe, the Bardi and the Peruzzi, are on the verge of collapse. The immediate cause: England's Edward III defaults on 900,000 florins owed to the Bardi and 600,000 to the Peruzzi, astronomical sums he had borrowed to finance wars and never repaid. However, what historians overlooked for centuries is that Edward had defaulted years earlier, and the bank survived for a period afterward. The third major bank, the Acciaioli, failed without significant loans to England. The true cause was structural. The centralized partnership model meant losses in any location impacted capital everywhere. External shareholders gained control of the Peruzzi, leading to conflicts over strategy. Wars across the Mediterranean increased transaction costs. The Champagne fairs, once the hub of European commerce, were declining as warfare made French overland routes too perilous. Records from the Arte del Cambio tell the story. 71 banks in Florence in 1339, but only 33 by 1360. This wasn't a temporary crisis, it was systemic contraction. Yet, within decades, new banking families, led by the Medici, rebuilt using superior organizational models. The collapse forced evolution. Weak structures perished, stronger innovations survived. The lesson? Financial crises don't destroy systems, they compel adaptation. The question is whether your organization possesses the structural flexibility to survive that adaptation. Then came 1348. The Black Death arrived in Florence. With a population of 120,000, by 1351, it had plummeted to 50,000, a 55% mortality rate in 13 years. The economic consequences were counterintuitive. In the immediate aftermath, wages for surviving workers skyrocketed. In Suffolk, England, reaping wages jumped from 3 pence per acre to 5 pence, a 67% increase. Across England, wages rose 20% to 40% by the 1360s. Workers could suddenly demand more, move to better jobs, and escape restrictive arrangements. The labor market inverted. Scarcity favored workers, not landlords. However, these gains in purchasing power are often negated by inflation. As fewer individuals are employed in mining, the production of gold and silver declines, yet a substantial volume of these precious metals remains in circulation. This results in more money competing for fewer goods. The significant inflation of the late 14th century partially offsets increases in nominal wages. Consequently, real wages, or actual purchasing power, show minimal improvement or even decrease in certain areas. Concurrently, demand shifts. The market for basic commodities like inexpensive grain collapses, while sales of luxury goods for the dwindling wealthy merchant class rise. Florence adapts by focusing on high-end luxury woolens. By the third quarter of the 14th century, Florentine luxury fabric rivals the once dominant Flemish producers. This strategy targets premium quality, premium prices, and niche wealthy markets. Nevertheless, reliance on imported English wool creates new vulnerabilities. Disruptions, competition, and tax burdens all squeeze profit margins. Florentine cloth production, which stood at 75,000 bolts annually in the 1330s, plummeted to just 9,500 bolts by the 1420s, an 87% decline. This pattern illustrates that when labor costs increase and markets shrink, businesses often survive by moving up market, offering premium products to premium customers in smaller volumes until eventually even that market segment can no longer sustain them. In parallel with banking advancements, Florentine and Genoese merchants pioneered another innovation: insurance contracts. The challenge was that Mediterranean trade faced both natural risks, storms, shipwrecks, and cargo loss, and human risks, corsairs, pirates, and government-sanctioned privateers disrupting rival states' commerce. The solution emerged around the mid-14th century. The first recognizable modern insurance contract was drafted in Genoa on March 18, 1343. Its structure reveals sophisticated risk assessment. Premiums reflected the route and distance. Longer voyages incurred higher premiums. Specific routes in the Western Mediterranean, frequently plagued by corsairs, commanded even higher rates. An analysis of over 7,000 medieval insurance contracts indicates that merchants perceived human risks from corsair attacks as more significant than natural weather risks. The specific route mattered more than the distance. This represents early actuarial science, distinguishing systematic risks from idiosyncratic risks and pricing them accordingly. Wealthy merchants with extensive information networks diversified their risks by insuring multiple voyages. They profited from the difference between the premiums collected and the actual losses incurred, effectively becoming underwriters. This system allowed merchants without extensive information networks to transfer risk to those who possessed better information, thereby reducing overall costs. A contemporary parallel is supply chain insurance, disruption coverage, and inventory financing. The COVID-19 pandemic reminded everyone that concentrated supply chains break down when disruptions occur. Safety stocks provide a form of insurance, and financial instruments distribute costs. Medieval merchants understood this concept 700 years ago. Let's connect these threads. Florence, around 1300, pioneered decentralized global supply chains centered on distant consumers rather than local needs. It developed double-entry accounting, which made complex capital flows visible and manageable. It introduced a standardized currency that fostered international trust without central authority. It established legally separated branch partnerships to prevent localized failures from causing systemic collapse. And it created insurance contracts that enabled risk transfer between informed and uninformed parties. Every single one of these innovations is undergoing reinvention today. Blockchain proponents advocate for decentralized finance without central banks. Much like the medieval Lex Mercatoria created commercial law independently of royal courts. Cryptocurrency advocates promote standardized digital currencies, mirroring how the florin established monetary stability through a credible commitment to purity. Modern multinational corporations structure themselves as holding companies with legally separated subsidiaries. The medieval model perfected supply chain visibility, with platforms tracking products from source to delivery, essentially double-entry bookkeeping applied to physical goods. The pattern is the same, the outcome is the same, and the vulnerabilities are the same. The Florentine system endured plague, banking collapse, labor revolt, war, and currency crises for over 200 years. It thrived due to institutional innovation, not solely capital or labor. The question for you is, which side of the wealth transfer will you be on when the current system encounters its downturn? If this forensic analysis offered you a new perspective, please subscribe. History holds the answers. I will show you where to look. Leave a comment. Type florin if you favor hard currency, or ledger if you support transparent accounting. I read every single one. The pattern is mathematical, predictable, inevitable, and it is repeating itself.